Hello and welcome to a new ATFX report. In this occasion, I'm gonna share with you 5 key factors to follow, to watch on the oil market to understand the next move of the price in the coming days. Next move of the oil market price for the coming days based on 5 key factors to watch. First of all, factor number 1, the OPEC uncertainty. We're gonna follow the last updates from the OPEC pretty closely, but this week, my friend, OPEC didn't take any decision. They didn't did any new statement, and this is bringing us the idea that maybe, just maybe, OPEC is insecure. OPEC is not feeling really confident with the next decisions because they don't know what is gonna be the demand in the coming months. They probably see a possible drop in demand based on what? Based on the macroeconomic data coming from the third biggest economic group in the world, which is Europe, which is getting into a recession, and therefore probably the demand of oil is not completely clear for the coming months. But it's not just that factor. There are other factors I will analyze with you in this video. No change in production or exports commitments. There was no new announcement, no new commitments from the OPEC, and we also know that the last deal, the last commitment they took, it was Russia and Saudi Arabia. Now they are friends. They are not anymore Russia against Saudi Arabia and US. Saudi Arabia apparently have changed the club and now it's a friend of BRICS. And since then, Russia and Saudi Arabia maintain commitments until the end of the year. We knew it before the end of the summer that Saudi Arabia and Russia will keep at least until the end of August a restriction on exportations from Russia and a restriction of the production from Saudi Arabia. Now that restriction and that reduction of production has been extended by the end of this year. So that factor reduced the offer of oil in the global market and therefore pushing up the price, which is what happens a few weeks ago. But now the situation is different. Now we're actually analyzing why the price of the oil was dropping in the last few days and the factors that could be behind of that movement, and also and mainly understand if that factors are factors that we can follow to predict the next movement or not. Factor number 2, Eurozone economic recession. Eurozone economic recession is based in new estimations of growth made by the banking industry in Germany predict that GDP in European Union gonna drop by 0.4%, drop by 0.4%, which basically means like the Q3 of 2023 European Union will be in contraction on his economic area. Eurozone retail sales contract by 2.1%. Another negative, the last data I was analyzing this week, it was that minus 2.1% on the retail sales on European area. Based on this information, we can predict that probably European Union is facing an imminent recession. We know that Germany is officially in recession. The growth rate of Germany the last quarter was completely zero. The previous one it was negative 0.2. We also know that Germany is the first economy in European Union, right? But one of the biggest ones is Netherlands, and Netherlands also announced that they are officially in recession. Poland, the 6th biggest economy in Europe, also announced 12 consecutive periods of decreasing on industrial production. Therefore, again, another country in Europe that is officially in recession. And we're still watching very closely the data from Spain, from Italy, and from France. Has the other 3 countries that are in the middle, in between Germany and Poland, that in case they also present bad results, bad numbers, it means like the whole European area will be in officially in a recession. So if Europe is in a recession and Europe is the third biggest economic area in the world, it means like the demand of oil probably gonna drops in the coming months, at least from a European perspective or side. So this is obviously impacting the global demand for oil. Factor number 3, US gasoline demand are dropping, and inventory of US gasoline is rising to the maximums of the year so far. So at this point, gasoline demand has fallen to yearly lows. Rising gasoline inventories, as you can see in the chart. Let's make a nice zoom. We are on the top maximum levels of gasoline inventory in US, and gasoline is one of the main derivatives from oil. if US is getting enough gasoline, it means like the demand for the coming months also should not be rising for the coming months. Reduced demand for fuel in coming months is the expectation we got based in this data. Factor number 4, US oil reserves, and this is completely different topic because this one is caused by a kind of trade war, by a kind of energy war on the energy market. We got from one side Saudi Arabia and Russia reducing the exportation from the Russian side and reducing the production from Saudi Arabia side. This kind of measures or this kind of commitments just generate a kind of a stress on the price, oil price, and that stress on oil price has been tried to get under control or contained by US, by the authorities of US, by selling off the reserves, the strategic reserves they got in US. So for the last few months, almost the whole year, we have seen how US has been burning and throwing to the global markets the reserves they got in oil just to keep the prices of the oil content or lower. I believe the reason is because they try to prevent any new spikes on the inflation ratio. If by any chance, this is the thing, it's a very strategic decision. If by any chance oil prices are keep rising and even start to quote about $100 per barrel, if that situation happens, it means like in one way or another, the price of the energy, the price of the heating, the price of basically of oil gonna rise globally, and therefore it's gonna be transfer of pricing to the rest of the goods and services. Why? Because absolutely everything you buy has been transported to your store, to your shop by driving, and because most of the energy in this planet is consumed is based on oil. Therefore, if the oil is rising, again, oil is the most inflationary asset in the world. If oil is rising, inflation sooner or later gonna rise. US know this, and that's why United States is trying to keep the oil prices low and cold. But with paying a very big price, which is burning out the reserves they got in oil. As you can see, we are in a minimum of 10 years. 10 years. Since 2010, US has been increasing the reserves of oil, and this is the first time for more than 15 years ago that US is dropping massively the reserves they got in oil. Now, factor number 5 is the dollar strength. We have seen how the dollar the last few weeks has been pushing higher maximums, higher prices over and over again. The last hito, the last goal done or achieved by dollar, it was just break out the maximums of the year, which it was around 106 points. It was broke out, and right now we are quoting around 107 points, but still probably the next goal is move to 108 points, the XY index, which is the dollar index. And in this occasion, if the value of the dollar is keep rising, it's causing a kind of deflationary effect on dollarizing commodities. Whatever is selling in dollars, whatever is quoting in dollars, which mainly is most of the assets in the world, international markets are quoting in dollars. So if you sell oil, doesn't matter if it's West Texas oil or if it is Brent oil, if you even sell another commodities like gold, like silver, palladium, whatever it is, any commodities quoting in dollars in international markets, if the value of the dollar is rising, those ones who sell commodities in dollars need to drop the price to adjust the value of the commodity. That's why we say that increase of the dollar value is causing a deflationary effect on all those assets who are dollarized. So because of this, a dollar rising constantly up is just causing the price of gold, the price of metals, industrial metals, the price of energy, which is the price of oil, keep on hold or even drop. We are facing, this is the last slides I'm going to share with you is just a chart with main levels or targets that we can monitorize in the oil market for the coming weeks. In summarize, we can see that we are in an energy war between US, Russia and Saudi Arabia to control the energy market. We also got another factor, which is the economic slowdown, mainly in Europe, and energy war between US, Saudi Arabia and Russia is causing this kind of movements, sharp movements on the price of the oil by sharp movements on the supply of the oil by increasing the supply, reserves of US, or decreasing the supply, restrictions on exportation of production by Russia and Saudi Arabia. Economic slowdown on Europe, dropping demand from crude oil worldwide in the coming months. US demand for gasoline weakening expectations for the future oil demand. And this is the price. This is the last chart I want to share with you, which clearly shows the Brent oil quotation. We are right now in $85 per barrel, more or less. But as you can see, the main levels we got there is supports. The closest support we're gonna face probably is gonna be around $70 per barrel. $70. That's from the bottom. If you are looking for long positions, probably the most nice entries could be around $70 per barrel, even $50 per barrel if that supports are getting broken. So we got basically two levels of probably entry buys in that prices. From the top, we can also see that mainly we got $85, one of the barriers. Right now we are moving in that area. I will describe these prices like kind of pivot point to decide either if the oil is getting certain support in $85,000 and move forward to again attack $100 per barrel and even perhaps broke up that level. Therefore the target on the top is $100, or if it's failing and it's losing $85 per barrel, it's dropping to $70 or even further $50. Whatever is the case, short on 100, longs on 70, longs on 80, massively longs on 80, and so on. I let you decide, because don't forget, this is not an advice of any kind. I'm just sharing with you my view on oil market. If you are considering to invest in any financial asset, I would recommend you just consult with a financial advisor first. Okay, that's all from my side. I hope you enjoyed this video, and if you like it, just click on like, subscribe, or leave you a comment on the bottom of the video. Thank you for watching, and hope to see you in the next videos. Take care. Bye bye.